For a long time, a powerful idea has shaped the luxury watch market. The idea that a Rolex isn't simply a watch, it's something closer to a financial asset. Many collectors and buyers came to believe that owning certain models was almost like holding a form of protection against economic uncertainty. The logic was simple. Demand always seemed strong, supply always seemed limited, and prices appeared to climb year after year. That belief intensified dramatically after 2020. For buyers who entered the market during the peak, the shift has been surprising. So the obvious question becomes, how can something that was widely described as a safe asset experience such a dramatic adjustment? The answer lies in understanding the difference between the intrinsic value of the watch and the speculative premium built around it. A Rolex watch didn't suddenly become less well-engineered. The materials, craftsmanship, and design are the same as they were before. What changed was the extra layer of enthusiasm and speculation that surrounded the product during the boom. To understand how this happened, it helps to look at how the Rolex market actually functions. Unlike many consumer goods, the Rolex ecosystem operates through a tightly controlled distribution model. Official retail pricing exists, but the watches themselves are distributed through authorized dealers who receive limited quantities of each model. Rolex produces a large number of watches annually, but demand for certain models consistently exceeds supply. Stainless steel sports watches in particular are often allocated in relatively small numbers to each dealer. This imbalance between supply and demand is a major part of the brand's identity. Scarcity increases desirability, and desirability strengthens the perception of value. Authorized dealers therefore play an important role in the process. Instead of traditional retail where products are simply available on demand, many dealers manage informal lists of interested buyers. Allocation decisions can be influenced by factors such as purchase history or long-term relationships with the store. This system led to a practice commonly referred to as bundling. Customers sometimes purchased additional items, such as jewelry or less popular watch models, in order to increase their chances of being offered a highly sought-after sports model. In that environment, the official retail price was often not the full story. It represented the listed price of the watch, but obtaining one at that price could require significant patience or additional purchases. Whenever access to a product becomes difficult, another market tends to appear. That's where the secondary or gray market comes into play. The gray market operates outside the official retail network. Buyers who acquire watches at retail sometimes resell them to dealers or collectors, willing to pay a premium in order to obtain the watch immediately rather than waiting months or years. This premium represents the price of convenience. It's not based on the cost of materials or production. Instead, it reflects the emotional and practical value of obtaining a highly desirable watch without waiting. During the pandemic period, several economic factors amplified this dynamic. Interest rates were extremely low, financial markets were highly liquid, and many individuals suddenly had additional disposable income. At the same time, new sources of wealth, including cryptocurrency gains and speculative investments, flowed into luxury goods. Watches became part of a broader culture of alternative assets. As a result, prices in the secondary market detached from historical norms. Some models traded at multiples of their retail prices. The environment encouraged speculation, with certain buyers purchasing watches primarily in the hope that prices would continue rising. But speculative markets are sensitive to changes in economic conditions. When interest rates began increasing and liquidity tightened, many speculative assets experienced declines. Cryptocurrency prices fell, investment capital became more cautious, and the enthusiasm that had fueled the luxury watch boom began to cool. The watch market followed that broader trend. Indexes tracking secondary market watch prices show that many models have retraced a substantial portion of their earlier gains. For buyers who purchased at the peak, the correction has been difficult. However, this pattern is not entirely new. Luxury goods markets have historically moved in cycles. During economic downturns, discretionary spending tends to slow, and collectors sometimes sell assets to raise cash. When confidence returns, demand can strengthen again. An important distinction also emerges between retail pricing and secondary market pricing. Luxury brands rarely reduce official retail prices because maintaining brand perception is critical. Instead, adjustments typically occur in the secondary market, where supply and demand fluctuate more freely. That distinction highlights an important lesson. When someone pays a significant premium above retail for a watch, they are not simply purchasing the object itself. They are also speculating on the continuation of that premium. If the premium shrinks, the underlying product hasn't changed, only the sentiment surrounding it has. Another factor is the composition of recent demand. During the boom years, a portion of buyers entered the market primarily because of the belief that prices would continue rising. When broader financial conditions weakened, that speculative demand declined quickly. Liquidity also behaves differently during downturns. In strong markets, highly desirable watches can sell quickly. But when economic conditions tighten, more sellers appear, while fewer buyers are willing to pay premium prices. Assets that once seemed easy to sell can suddenly take longer to move. This leads to another important comparison. A Rolex watch is sometimes described as a store of value, but it behaves very differently from traditional safe haven assets such as gold. Gold often rises during periods of fear or financial instability. Luxury watches, on the other hand, are closely tied to consumer confidence and discretionary spending. In other words, their demand is strongest when people feel financially secure. None of this means that a Rolex lacks value. It simply means that its value should be understood in the right context. The design, engineering, heritage, and enjoyment of ownership are real reasons people buy these watches. Price appreciation may happen over time, but it should never be assumed as a guarantee. The idea that any luxury product can permanently defy economic cycles is unrealistic. Retail prices may gradually increase over the long term, but the premium paid in secondary markets is far more sensitive to sentiment. And sentiment, as history repeatedly shows, can change quickly. Which brings us to the central question. Is the premium often seen in the gray market simply the price of bypassing long waiting lists, essentially a convenience fee? Or does it reveal deeper structural issues within the luxury watch distribution system? What do you think?